Today, we're going to break down a pretty interesting investment product, the Kotak Multi-Asset Active Fund of Funds. Sounds complicated, right? Don't worry. By the end of this, you'll get exactly what it is, how it works, and who it might be a good fit for. Let's get into it. So let's start with a question I think a lot of investors face. You want to get in on the growth potential of stocks, right? But you also want the stability that bonds can offer and maybe a little gold to protect against inflation. How on earth do you do all that at once without having to manage like 3 different accounts and constantly rebalance everything? Well, that's the exact puzzle a fund like this one is designed to solve. You see, this is what's known as a fund of funds. It's a pretty cool concept. Instead of the fund buying individual stocks or bonds directly, it actually invests in other mutual funds. The MasterChef analogy here is just perfect. You're not in the kitchen picking out every single vegetable and spice yourself. Instead, you're trusting a professional chef to pick the best ingredients, in this case other funds, and put them together to create one perfectly balanced meal for you.
Okay, so let's dive in. What really is the big idea behind this fund?
Well, if you look at the official documents, the goal is long-term capital appreciation. Let's translate that into plain English. It simply means they're trying to grow your money over the long haul. And the way they aim to do that is by building a portfolio that invests across 3 main areas: equity funds for stocks, debt funds for bonds, and commodity funds for things like gold. So, if you decide to invest, where does your money actually end up? Let's, take a peek under the hood and look inside the portfolio. The whole strategy really comes down to these 3 buckets. You've got equity for growth potential, debt for a bit of stability, and commodities like gold and silver, which often act as a hedge. The whole idea is to give you diversification in one single package. So hopefully when one part of the market is having a tough time, another part might be doing well. Now, this is where that word active in the fund's name becomes so important. Just look at these allocation ranges. The fund manager has a ton of flexibility here. They can take the stock portion from as low as 10% all the way up to 80%. So if they think the stock market is looking too expensive, they can pull way back. Or if they see a great opportunity, they can really lean in. This active management is the core of how this fund tries to navigate whatever the market throws at it. So that raises a big question, right? How do they actually decide when to make those big shifts? Let's take a look at the brains of the operation. It's not just a gut feeling. The fund managers are looking at 4 key signals to guide their decisions. First, they analyze market valuations. Basically, are stocks cheap or expensive right now compared to their own history? Second, they check something called the yield gap, which compares the returns you might get from safer bonds versus riskier stocks. Third, they track gold and silver prices, which can sometimes signal economic uncertainty. And finally, they look at momentum. What's working in the market right now? By combining these signals, they decide how to adjust the portfolio. Of course, no investment comes with a guarantee, and there are always risks and costs involved. It is absolutely crucial to understand these before you even think about investing. So let's do a quick reality check. First things first, risk. The official riskometer, which is designed to give you a clear idea, rates this fund as very high. Now, why is that? Well, mainly because of that flexibility we just talked about. Since it can invest up to 80% in equities, it has the potential for some pretty big swings, both up and down. That's often the trade-off for aiming for higher long-term growth. You just have to be comfortable with that volatility from day one. All right, let's talk about the fees. The first one you might encounter is something called an exit load, and that's basically a fee you could pay if you decide to take your money out too soon. Here's how it works. If you pull your money out within the first 6 months, there's a 1% charge. But if you stay invested for more than 6 months, that fee is completely gone. They do give you a little leeway, though. You can actually take out up to 8% of your investment during that first 6-month period without paying any exit load at all. The second major cost, and this one is super important, is the expense ratio. Think of it as a small annual fee that covers all the costs of running the fund. It's taken directly out of your investment returns every year, and as you're about to see, even a tiny difference can add up to a lot over time. This little table is a perfect example of why that expense ratio matters so much. A direct plan, which you buy straight from the fund company, has a lower expense ratio than a regular plan, which usually involves a distributor's commission. Look here, both plans start with the exact same return, but because the direct plan has lower expenses, you end up with more money in your pocket. Now imagine that small difference compounding year after year after year. It really makes a difference. So after all that, we've covered how it works, what the risks are, what the costs are, which brings us to the big question, the bottom line. Who is this fund actually designed for? Well, the fund documents are pretty clear about this. This product is suitable for investors who are 1. Seeking long-term growth, 2, looking for that all-in-one solution that invests across stocks, bonds, and commodities. And 3, this is key. You have to be aware of and comfortable with that very high risk rating we talked about.
And if that description sounds like it might fit you, well, getting started is pretty accessible. The minimum initial investment is just 1,000 rupees. Now, remember, our goal here is just to help you understand the product based on what the official documents say. This is not personal financial advice. The absolute best next step is always to talk with a qualified financial advisor who can help you figure out if an investment like this makes sense for your specific situation and goals. So the final question to leave you with is this. Could an all-in-one, professionally managed, and actively adjusted approach be the right kind of strategy to help you reach your own long-term goals? It's definitely something to think about.